Hey everyone, and welcome to today's Explainer. We're diving into a super fascinating piece of global economics and history today. We are looking at a high-stakes dynamic that could honestly flip the rules of the financial game completely upside down. We're going to unravel this really complex topic that connects the economic choices of past empires right to the modern strategies of today's superpowers. So get ready, because understanding what we're talking about today is absolutely crucial for figuring out exactly where the value of our money is heading. So here is the big question to kick things off. Is the United States right on the edge of making the exact same mistake that destroyed the British Empire? I know, it sounds like a totally dramatic premise, right? But as we'll see, there is an undeniable historical parallel driving current economic policy. To figure out if this modern empire is stumbling over the exact same stone, we first need to take a look at today's global economic chessboard. Section 1, the secret of Chinese success. Okay, let's dive right into this, because before we look at the past, we really need to understand the present, which is largely dominated by China's massive strategic advantage in global manufacturing. The fundamental dynamic today really boils down to this: a weak yuan going toe-to-toe with a strong dollar. The People's Bank of China actively manages its monetary policy to keep the yuan cheap compared to the US dollar. And you might be wondering, why do that intentionally? Well, it makes products manufactured in China an absolute bargain for foreign buyers. It essentially acts as a massive magnet for global demand. A weak yuan has this brilliant dual impact. On the one hand, it massively drops the price of what China sells to the rest of the world. But flip that around, and it significantly increases the cost of what China buys from abroad. Naturally, this discourages Chinese citizens and companies from buying foreign products. In practice, it perfectly favors buying locally made goods and creates this invisible shield that protects their national industries from outside competition. Section 2, Great Britain's mistake. This brings us right back to Great Britain in the 19th century. Because to really grasp the dynamic between the United States and China today, we have to look at the ghosts of empires past. Back in the 19th century, Great Britain was literally known as the workshop of the world. Thanks to the Industrial Revolution, they absolutely dominated the physical, real economy of the entire planet. I mean, they were churning out almost all of the world's coal, steel, and textiles. This was a nation built squarely on smoking factories and tangible physical production. But here is where the fatal historical mistake happened. Bankers in London discovered something pretty tempting. It was simply a lot more profitable, and frankly, a whole lot easier, to lend their money abroad rather than investing that capital into modernizing the factories on their own soil. They basically chose finance over manufacturing, and little by little, their real physical productive capacity was overtaken by a young, incredibly industry-hungry nation, the United States. Section 3, the shift in global power. That crucial decision to abandon the real economy in favor of financial services? Well, that brings us to the dramatic climax of this story, where the loss of that industrial base finally catches up with the empire. The fall happened surprisingly fast. First, right after 1945, the massive financial toll of two world wars left Great Britain essentially bankrupt, forcing them to take on massive loans from the US. Then came Bretton Woods, where the change in leadership was made official. The US dollar completely dethroned the pound as the global reserve currency. And finally, we hit the Suez Crisis, which was the ultimate litmus test for this brand new world order. So during the Suez Crisis, Great Britain actually tried to invade Egypt to take back the canal without getting Washington's permission. And the United States' response? It wasn't military at all. It was purely financial. The American president literally threatened a massive sell-off of the British government bonds that the US was holding. Doing that would have destroyed the value of the British pound overnight. Great Britain had absolutely no choice but to withdraw in total humiliation. Which leads us to this incredibly powerful realization. The British Empire no longer existed, and the US was the new boss. That day, during the Suez Crisis, the entire world woke up to a fundamental reality. Financial leverage now dictated global power. Without its own factories, and completely depending on another country's money, Great Britain had totally surrendered its economic sovereignty. Section 4. The United States repeats history. Now, what's really fascinating here is how much this acts as a historical mirror reflecting our exact situation today. Let's bring this analysis right back to the present. The comparison is honestly staggering. In the 20th century, the UK traded away its factories for financial services, making London rich but completely neglecting its manufacturing base. Fast forward to the 21st century, and the United States has done exactly the same thing.
We enriched Wall Street with financial services and stock wealth, but we hollowed out the real economy by losing our physical factories to China. And the consequences of this outsourcing have been severe. Driven by the search for cheaper labor, the decline of American manufacturing accelerated, leading to a huge loss of physical production. But here's the most critical part. By shipping those factories overseas, the United States basically handed China the perfect opportunity to absorb its technology, its designs, and build up a completely unmatched manufacturing capacity.
Section 5. Devalue to compete again. So, how do you avoid suffering the exact same fate as Great Britain? The mechanical countermove that the U.S. government is currently considering is a pretty drastic strategy. To actually become competitive again as an industrialized nation, there's a 3-step strategy unfolding. Step 1, which we've already started to see, is raising tariffs on imported goods to protect the domestic market. Step 2, and this is the absolute key move, is devaluing the dollar. By intentionally making the country's currency cheaper, you make Step 3 possible, creating the economic incentives for factories to finally return and reactivating local production, which protects the everyday citizen working in that real economy. But, and it's absolutely crucial that you understand this, because it hits right at your wallet, this macroeconomic strategy has a very personal cost. Saving the real economy of factories requires a more competitive, meaning cheaper, dollar. So the inescapable cost here is sacrificing a portion of global purchasing power, and by extension, that hits the value of dollar savings all around the world. Which brings us to our final big question. Will it actually be worth sacrificing a part of your dollar savings and your purchasing power just to recover those factories and reclaim the country's industrial independence? It is the ultimate trade-off, really, short-term financial wealth versus long-term industrial survival. It's a monumental historical decision, and the clock is definitely ticking. Thanks so much for joining us for this explainer, and stay curious.